Welcome to all the participants to our webinar on a very pertinent topic, which will be taken by one of our very learned friends, Mr. Sridhar Kalyansundaram. Before we start, I would just like to introduce Sir. He's an experienced banker, having 30 years in banking industry in India and Africa in MNC Banks. He has also worked as management consultant across various verticals like BFSI, Telecom, media in India, Middle East and Africa, and SME for risk management, BPR, IT service, and risk management products. He has also been Chief Risk Officer of ESAF SMALL FINANCE BANK, Thrissur, Kerala, India. So we'll start the session, handing over to Sir, and to all the, if you have any questions or queries, you can put in the chat box. We'll take after the session is over. Over to you, Sir. Thank you.
Thank you, Shyam. Thank you, Dr. Agrawal. Thank you, Risk Management Association, for this wonderful opportunity. And thank you for all of you for taking out time on a second Saturday to, the interesting topic, very contemporary, contextual, and without any doubt, very important for people who are interested in risk management, which in my opinion should be everybody. So with these few words, I hope to take you through some of my thoughts through what should be the risk management, role of the risk management in an SVB situation. So let's look at that. So with your permission, I will share my screen on what we need to discuss, some discussion pointers. Can you see my screen?
Yeah, we can see.
It's visible.
Very good. Yeah, very good. So the role of a risk management in SVB-like situation is very important, because what we learn from some of the lessons is most important. As they say, how much ever intelligence you have in terms of protecting, very sensitive leaders and all that, particularly the Secret Service of the United States, which is supposed to be possibly the best apparatus to protect one of the most sensitive political leaders in the world. The rule there is always prevent the second bullet. No matter how much intelligence you have, now you'll wonder why they have a rule like that. Because no matter how much intelligence you have in terms of perceived threats, attackers' profiles, face recognition, artificial intelligence, so on and so forth, there is always a potential that you will be taken by surprise. So the rule for even such a critical apparatus like the Secret Service of the United States is to put yourself in between the asset to be protected, that is the POTUS or the President of the United States, and the bullet. So even it means if you are placing yourself on the line. So that's the rule. So what does that say? If you look at it as a philosophy, yes, if you are not going to be fully prepared, can you at least be fully prepared to react? So both of it, one is being precautionary, preventive, if possible, to the extent possible. And that alone is not a box to be ticked. The next box is, in the event of your being taken taken by surprise, then can you at least be very nimble to react? That's what we are going to discuss, or we're going to be the theme of our discussions this evening. So with this small intro, let's look at the bank that failed. It was not any small bank. In fact, according to the Federal Reserve statistical release, it was the 16th largest bank in the United States. It was much, much larger, very, very large. So it was not as if when small bank somewhere who was not very prepared, who did not have the, let's say, reactionary methodologies, apparatus in their arsenal, and therefore, they did not have the means to survive. That did not happen. It was one of the largest banks. Not only it wasn't the largest bank, you know what they were, in terms of composition, they grew very well. Now, growing very well has never been the reason why somebody fails. Not growing has been the reason why banks have failed. So that is because of lack of planning, lack of, let's say market bandwidth, market perception about that organization, so on and so forth. So here, massive growth was witnessed. Not only massive growth on one side of the balance sheet, that cannot happen, you'll have to balance it out. They had tremendous or humongous growth both in the deposits and assets. People from the financial industry will immediately know what this means. And they held very small amount of cash. Normally, when you have a large inflow of deposits and you don't have a lending program to match it, you are saddled with very inefficient holding of cash. You may have enormous amount of cash, but if the cash as a financial institution is not deployed, it is a huge amount of inefficiency. Because banks basically are the intermediaries who are supposed to, garner deposits and then deploy them in, good assets and make the money in between. So that also was done very well. Very small amounts of cash was held. And more importantly, what did they do? Where they did not have lendable, products, they did not simply go through money at all sorts of lending products. They went and invested it in treasury bonds. Now, T-bills globally are seen as the strongest method of investment, particularly for a financial institution, for everybody. And other long-term debts. Long-term debts have two significant implications. One is a continuity of the income potential. All of us know that because it's a long-term contract between you at the bank and the borrower on a particular rate of interest, whether it is floating or, a fixed rate, there is a continuous income flow if everything is all right. Right? So therefore, long-term debts are a perennial source for the term of the contract of its income flows. And if the borrower is rated very well, it is even as good as the treasury bonds, or probably just below that. So it ticked even those boxes. So therefore, the Investopedia article that I have quoted here, or even an excerpt from that article, was very correct in saying a relatively low risk in what they have done. In what they have done here is the Silicon Valley Bank. If all these are also good, why did they fail? That is what we are going to look at to see the template that we are supposed to recognize. We are now required to recognize, right? So if you dissect the Investopedia required, massive growth, very small amount of cash, these are all tick the boxes. These are what, if your bank was doing it, let's say each one of you here are in the banking industry and you will be inspected, audited, by Reserve Bank of India, the regulator in India, he will tick all the boxes and will rate you as probably a low risk in his what is called the RAR, the risk assessment report of the regulator. And everything ticks the boxes. So what it again begs the question, if everything was going fine, what happened on a particular morning, right? We will see about that. So when we see very small amount of cash, this is what everybody tells you. Keep your cash, to the lowest extent that you will require. For the most minimum, today with UPI and other things, even the vendor, where typically all their sales were in cash, the roadside vendors, the small eateries, the Nariyal Ka Pani, that sort of vendors, where all their sales were in cash, and therefore in the evening, they would have to, when they close their or bring their shutters down, they would have to worry about, how to safeguard it and then look at, very quickly to dispose it off to the next day supplier and stuff like that. So literally cash management was becoming a big problem till, of course, we are at the height of the hump and we are only, going stronger and stronger with UPI and all that, which brings us to very prudent banking practices, even from the customer side. So if you hold very small amount of cash, you as a banker, you have been very prudent. Treasury bills are, are the safest, or at least till the recent event of SVB itself. There is no doubt. On the 7th of March, if you had asked anybody which is the safest instrument for any bank anywhere to invest, they would have said US Treasury bills, without any doubt. No what do you call, bias in that. Why? Because it was so. Now, probably the questions arise, what do you, within 30 days, the scenario has changed. We are not yet on the 7th of April, on the 8th of April today, it's almost the anniversary, the monthly anniversary. But till as recently as 30 days back, that was the, the gospel, if you want to, So, how both of this created an illiquid situation? Because we all now know there have been tomes and tomes of blogs written on what went wrong with Silicon Valley Bank. So we are trying to dissect to find out, did they do something wrong? In 2008, we all knew there was a very large name that sank under, and one large name that barely survived. They were all hundreds of years old institutions, both Goldman Sachs and Lehman Brothers. And yet, one barely survived, the other did not, because fundamental issues were there. So here, we have now looked at whether there are fundamental issues. Apparently, it looked like there were no fundamental issues. So what contributed to the illiquid situation? So if you look at it, did it really lead to a liquid situation? It is a very ambiguous answer. It is both yes and no. Why is it yes and no? Let's look at it. Because it was not able to convert its bonds, into a liquidity that was required to meet a particular requirement. We will discuss as to what even led to that liquidity, requirement. And T-bills, which are supposed to be the best source for raising funds. Normally, bankers invest in, treasury bills and other things so that they can raise money when in requirement. So, till such requirements are sensed and prepared for, and actual, the process of converting those investments into liquidity, that means basically selling it and converting it to cash. That takes some of the deals are T+1, some of them take T+3, whatever settlement, denominator that works on that. That is not the problem. The problem is you are dealing with the best of the things. Normally, you should have got back your investment, if not more. But what happened was you were not even able to raise it. In fact, they had to take a huge haircut, almost, amounting up to 20%. 20% on T-bills is something like an unheard of story. It is not even fiction, at least till recently. So therefore, it created a situation where what was considered a strong fort, a fortified area of investment itself became their problem. Now, before we go into this, we'll have to step a little bit back. What created this problem? We will look at some of the, issues that came up with the T-bills themselves. All of us know, the interest rate regimes in the world are directly, related to the inflation rates, of the economy at the macroeconomic level, all this stuff. That is, while we will touch upon it, we'll touch upon it as to where you need to look at it as a horizon, where your focus has to be. We will not get into the mechanics of inflation correlation to interest or vice versa. Why? Because that is a separate topic by itself for a webinar. In fact, a webinar, one has to be an expert in macroeconomics or monetary theories to be able to fit it into a 1 hour discussion sort of thing. It's a vast subject, as most of us already know. However, we will try to fit in the essential concepts into our discussion. What happened globally with the type of economic downturn that is anticipated in some countries, that is already happening because of the aftermath, various recessionary trends that we all witness, and so on and so forth. The macroeconomic policy making apparatus in almost all the countries, which is normally the monetary authorities, which is the regulator, banking regulators, or the financial sector regulator, the Federal Reserve in US, the Reserve Bank of India, at home here, and so on and so forth. All these bodies where they, work on what are the, reactions that we allow to bring into the interest rate regimes, and and respond to the various macroeconomic situations or anticipated macroeconomic situation for various, objectives that have been set both by the political leadership and by the economic conditions. So therefore, when we look at what happened in the United States, we all know in the period preceding this SVB benchmark date, of the 7th of March or the 8th of March, if you want to look at when the actual run started, right? You will see that the Federal Reserve has been gradually, but definitely moving on from the base rates and to the higher rates. Now, as way back, there is one very interesting book, Interest Rate Changes. Actually, I'm a great fan of Dr. Sridhar Krishna of ICFI. He even way back in 2007, he and ICFI, they released a book called The Dynamic of Interest Rates. Even there, that is even before the 2008, sort of a situation, because this was published in 2006 and became very popular in 2007. And it's actually a collection of economic essays. And even there, political analysts, economic analysts, and particularly on the banking sector, people have pinpointed the issues of the paradox between the interest rates and the bond yields. So very briefly, we look at what led or what could have been the reason. So treasury bills being the top of draw, option for all the banks world over, where if many of the global banking institutions were free to invest in any opportunity where they sensed there were. Whereas in some regions, like in India, for example, if it was State Bank of India or even an ICICI bank, they would need certain type of eligibility criterion, permission regime for investing in certain type of investments. Whatever asset may be, the conditions, treasury bills of the United States are particular. Any country, if you are in India, treasury bills were the best options because they were tradable. You could even use it to, account it for your various statutory reserves and so on and so forth. So they had many dimensions to an option as an investment. So they were called gilt. Normally the coupon rates were fairly decent. And if you held it on to maturity, you were only, holding on to your investment at investment value, and you are also able to use them as collateral for raising cash whenever you wanted in the system. The problem with it was when you wanted to, sell them, when you wanted to realize the cash. So then what happened was what the two important, elements that went was the interest went the wrong way. That means when the interest rates went up, the treasury bills, the yields and the value come down. We will look at very briefly, why this happens. We'll look at it in the next few discussion points. And because there was, a huge gap between what you sold and what you actually realized, which you were earlier counting as 100. You had to pay somebody $100. You thought your treasury bills of $100 will get you $100, but you had to take a haircut. In some cases, as high as 20%. So you got only $80. So there was a mismatch. So when your asset liability mismatch kicks in, your ALM theories, become questionable. Your ALM management certainly is under a lens. So that is basically the problem that went wrong. So what contributed to that is basically the interest rates and bond prices. Before we go to that, we need to understand this basic concept. Most of us who already know, there will be many of the new friends who may not know. When the interest rates go up, the bond prices the yields come down. Why would this happen? Because when the interest rates go up, the newer bonds that are brought into the market obviously carry a higher tag, interest rate tag, the coupon rates. So therefore, the earlier regime, the bonds that were issued in the earlier interest rate regimes become unattractive. So therefore, for the same 100, a new investor would get a higher coupon rate bond. So he would not buy what you're trying to offload. So what would happen? You would try to take a haircut and say, okay, my $100 bond, you give me 96 because I need the cash now. So what happens is your $100 bond, 100 rupee bond is now having a lower yield. So this is in a very simplistic thing. Of course, there is far more complex mechanism, the background of this. We will not get into that because that is not the scope of this webinar discussion. So we will at this point use the headline to say when interest rates go up, and this is one of the reasons, as we will see how the regulators have reacted post SVB situations. We will see why this is, what has been the local RBI response to that and how do we understand it. So therefore, when interest rates go up, even as they start going up, or where there is a what we call a heat map that tells you that there is a potential for the interest rate to go up. One of the most important thing, the risk management, at least market risk management in the financial sector, in the financial industry, or at least very closely to the banking industry, how quickly they are able to react to this. So if you are off the block faster, you probably will take no haircut, or even if you have to take a haircut, probably you would have sold it at 99 and not at 92. So therefore, you would have probably come off better in such a situation only because your, as I call it, your eye was on the ball, right? So this is the interest rate driven issue, but interest rate alone is a very easy peg to hang the whole issue on. It's very easy. All of a sudden interest rates went up. Interest rates don't go up all of a sudden. There are a lot of deliberations. It's very, very difficult for a central banker or any other authority in any country to simply one day, simply move the clock onto a different rate of interest. It's not possible. There will be very, very, let's say, severe ramification on the industry in terms of what the funds that can be lent and so on and so forth. And politically, it can be disastrous, as we have seen any number of examples all over the world. Anyway, that is not, again, what we need to use as a reason why we should be on the top of the game. SVB is a very good eye-opener. If it can happen to a large corporation like SVB, they were not any small. It can happen to anybody, whether you are larger than SVB or smaller. So first is the interest rates. Second is actually, in my opinion, personally, their total, let's say, not so keen ALM practices. If they had only thought about, do I have the money to look at any, let's say, call on my deposits, they would have been far more alert than what happened on the 7th of March or what announcements that triggered the 8th of March delege and all that. Very importantly, here, when we talk about asset liability mismatch in any banking situation, assets are, what is owed to you and liability is what you owe others in very simple terms, your lending book and your deposit book, your loan book and your deposit book, if you want to put a layman tag to that, right? So when your deposits, most of the banks you would have found, some of the very recent announcements, I can recall saying 55%, we have reached a CASA portion of 55% of our total deposit book. CASA is, all of us know, current account and savings account deposits. Current account carries literally 0% interest. Therefore, current account balances are the darling of any banker because it is funds available at 0% cost, right? So he can deploy it whatever, the best of the rates, triple A grade rated clients, he can lend it even at 6% and 7%. So less is operating cost, the balance is what we call NIM, net interest margin. So current account being to a large extent is a very favorable thing. Next is your savings bank account. Most of us know from our personal experience that savings bank, which we all keep, whatever money for an emergency so that we can draw or use our debit card to pay for our Amazon purchase, whatever else we do, we know that is the lowest yielding investment. So we try to keep as little as possible there, but that is also low cost funds for a banker. So therefore, where a bank says we have got 55% CASA deposit, what he is telling you is 45% of his funds are term deposits. Term deposits by definition are term contracts, 6 months, 1 year, 3 years, 5 years, whatever. Right? Recently, I found one of the small finance banks, announcing 999 days deposit, which is fantastic. 999 days is almost how many years? Almost close to 3 years, but they didn't say it is 3 years. So these sort of term commitments, and if you wanted to prematurely withdraw that, or what is called pre-close the deposit, you will stand to lose on interest. So normally the tendency is, unless there is an emergency, these deposits are quite stable. But on the flip side, these deposits have to be attractive. This particular case that I said, it was possibly one of the highest rates today in the banking industry, right? So it comes at a very high cost. From zero to that high cost is your average cost of your total source of deposits. Now, why are we talking about the liabilities so much? Because they have a pertinent point in the SVB problem. SVB had, almost close to, $160 billion in deposits, of which close to, if the statistics are correct, 92 billion only in what is called checking account, which is equivalent to our current account, no cost funds. But the problem with this particular segment of deposits is they can be money at call. Your customer can show up tomorrow morning at your counter and say, boss, I want this lakh of rupees that I have in my account, and you'll have to meet or honor the commitment. Otherwise, you will go down as a bank. So therefore, this is, while it is zero cost fund, it is also money that can be called up tomorrow morning. So therefore, in asset liability management, one of the most important thing that we have been taught, in the generous introduction that Mr. Shyam Agarwal gave me, I have been in the banking industry on both sides of the table, both as a functionary for 31 years and as a consultant, for almost now 10, 12 years. I sit on the board of a bank, and one thing I can tell you in all these years of association with the bank, one thing that gets drilled into you is, do you know what you owe the customers tomorrow morning? Why do I say this? Because tomorrow morning you need to be ready with this money. As a bank, as a branch, at your counter, as a teller. So at the point, now the customer may actually show up or not show up. That's a different issue. But are you ready? And this is one of the biggest reasons that went to the slide of SVB. When SVB found out that it had to raise liquidity in the market, in the event, because in the United States, and particularly in their clientele, there's all the technology companies. And technology companies park all their income and they meet their payroll out of withdrawals. Like even we have specific products for that in India. So it's not surprising from an Indian context. But what went wrong was when they found out that they had to take huge haircuts to meet the next payroll demand, they made an announcement that they had taken a 1.8 billion loss, and to set right the loss, they are going to raise equity. In India, if this announcement had been made, let's say by any bank, you can name whatever bank you want in your mind, it would have been seen as a very honest statement, and it would have gone down a lot of brownie points. They would have got a lot of, let's say, incremental value in their perception in the eyes of investors, because these are very bold statements to make. This also announces to the public, to the investing community, that the bank is on top of its game. Unfortunately, the United States, exactly the opposite happened. Exactly the opposite of that happened, because depositors felt, oh my God, if these guys are losing money to raise cash to pay me, I better go grab my cash before they start losing more money. And this single sentiment worked against them. Almost $44 billion of the $92 billion got withdrawn on one single day, 8th of March. Now, after that, rest is history, as they say. Unfortunately, not so pleasant history. At least from a financial industry perspective, this has been a significant lessons learned. Significant lesson learned. The liquidity coverage ratio, which we all use as a benchmark to look at how much of liquidity do we hold to cover our, commitments, has not something that did not crop up yesterday. It has been there right from, the focus of it, let's say, went about 100-fold higher in after the aftermath of 2008. But it has been a concept that has been there all the way. In fact, liquidity risk got spun off as a separate risk. Earlier, it used to be a part of your overall risk, in your camels and other rating mechanism. It got spun off as a separate risk because liquidity became a separate issue for a bank or any financial institution apart from its capital structure. So the ALM management is possibly the larger peg on which I personally would hang the SVB story than on the interest rate regime story. So this is from a very popular text on what ALM is, since Dr. Agarwal has already, told all the participants. I saw a few questions coming up earlier also. Will we be given a copy of this presentation? Oh yes, you will be. He has already promised. So it will be very useful for you to look at it. But very importantly is liquidity is its ability to meet its liabilities. In India, we can borrow to repay. Normally, this is the beginning. In all prudential financial management, in the university level textbooks, if you are borrowing to repay a debt, it always indicates that you are in the top of a debt trap. But if it is managed well, it can actually be excellent liquidity management. So therefore, you can manage your commitments through borrowings or by converting your assets. And that is exactly what your LCR is all about. What are the type of high quality liquidity assets, liquid assets that you have to meet your commitments over a 30-day horizon or whatever, according to various structures of the products. So what happened when you had a liability side, which took more of current account, which is money at call and not so heavily term type of commitments. So then you had to keep your liquidity levels also very high, which unfortunately, when you try to keep it, the market, because of the interest rate regime happening parallelly, did not have the bandwidth for you to convert your $100 band into a $100 liquid cash. So therefore, the gap had to be met either by borrowings or even by your own equity. And that is what SVB announced. So while we understand what happened, or we try to dissect, and as they always say, in the, in retrospect, everybody's voice. So we are all now sitting here in the comfort of our, webinar and dissecting what went wrong. But one of the most important things that went wrong in SVB was, as you can all, probably most of you know, is it did not even have a chief risk officer for the preceding 8 months. The guy who was there quit, and they did not, such a large bank with such a large balance sheet, did not deem it fit to replace the guy for whatever reasons. So therefore, what happened? You did not have the guys who are supposed to take care of this. Probably somebody was double hatting. So we do not know what hat he was wearing on that particular eventful day, right? So this is one of the problems of went on. So if you look at it, right, even Mr. Michael Barr, the vice chair of the Federal Reserve, where he was called up, before the Senate Committee of the, Senate of United States, where he made a very clear statement. In fact, he was very critical of the bank, and to be very fair, he was critical of his own Federal Reserve's supervisory practice. But then, fine. I mean, while we can tick off the good boxes, what we all need to take out from there, this is not an assessment of the Federal Reserve's functioning. It is in a dissection of the events to understand what we learn from that as risk management practitioners. So keeping in, focus that particular view, when we look at even the statement of somebody as senior or as high up in the totem pole as Mr. Bar, you see that when both of them work together, liquidity and business risks are not properly maintained, are not properly addressed, are not properly focused, you are running into a situation that today probably will carry the tag called the SVB situation. There has been any number of cases which have probably not been as, let's say, spectacular as the SVB failure. But there have been any number of cases, even in the United States itself, both prior to pre-SVB, you will be very surprised, even post-SVB. Some of you who are not following the events will be surprised as much as 550 banks have, gone under after that. It's because of the strength of that economy, they were able to take the shock. I don't see any other economy anywhere else in the world taking a shock of that sort of dimensions. But that is about a commentary about the United States economy, right? So what is very important is the liquidity factor of an organization. How liquid are we? You keep too much cash, it is inefficient. You keep let's say, insufficient cash to meet your requirements, it's again, disastrous, as we have seen from the example. So what is the business risk that contributed to that? One of the most important things that did not happen there, as it now appears, is the business mix that is happening in the bank was seen more as a performance-driven monitoring than risk management, perspective. What do I mean by this? While people were gung-ho about going about, their business, liability business, right? The reason I'm using this particular terminology called gung-ho is because we will again use it when we look at what are the solutions, right? Or what, in my opinion, are the solutions. So when you are gung-ho, sometimes we run in a bank, liability week or deposit mobilization week. The risk management has to now not even sit in his chair. He has to not just sit up, he has to stand up. He has to look at what is the maturity ladder, maturity profile of those deposit mobilization. Because we know right from window dressing, getting deposits for this Friday or reporting Friday, where it will vanish on Monday. So while it comes in, it is great, but when it goes out, are you prepared? So he has to be more alert when people announce these sort of schemes, one. So, and again on lending side, where you are increasing the bar and saying, I will lend only to the AAA rated guys, you are automatically cutting off the number of applicants who can come to your door for any borrower. So you are only picking and choosing the best of the best. Now, best of the best to come to you, you need to be the best of the best. So even there, when you're lowering the bar because you now need more, deposit deployment sources, which is exactly what led to the subprime and other CDOs and other MBO sort of products, and then, creating derivatives out of that, and so on and so forth. All the history that we have seen, even in beautiful movies like Big Shot and all that, right? So you can, you need to be out of your seat. You are not driving the business, but you are driving the risks associated with the business. So therefore, when both of this are, being announced by your company for whatever reason, are going very hard on these focus areas or simultaneously, then the risk management has to be alert. In SVB case, we found out there is nobody to head that particular department. And that possibly can be one of the strongest contributors to what went wrong, right? So what is the role? So far we have been looking at dissection and all that. So what is the exact role that we have for a risk management, chief risk officer? We will look at it. If you want to know academically, we will start by saying, identify the risk, assess the risk, develop the management strategies, monitor and report, crisis management. Crisis management in the financial industry is very, very important. While we are all competitors, we don't want anybody failing. I still remember during my working days where we were called out of, our office houses on a holiday period like this, this weekend, because one other competitor bank was having almost what was nearly a run on the bank. So people started withdrawing from the ATMs, you know. So we were asked to go in whichever bank I was working at that particular period to go manage. So though it was not our job, all the senior guys were out on the streets, you know, going to the nearest ATM or selected ATMs, telling people, don't worry if there is no cash, we are arranging for cash. Though we knew the people standing there were not withdrawing cash from my bank account. They were using my bank ATM to withdraw cash from their account in that particular bank that was in a threat. I'm very happy to tell you, measures taken by the rest of the banking community in that particular period not only saved the bank, today it is one of the largest banks in the world. Now, why am I telling you this? This is the crisis management that all banks do. So why this crisis management did not help Silicon Valley Bank in the more mature market like United States? Not because they don't have it. They do. They have very strong practices. If you look at some of the academic inputs that come from them, some of the case studies that come from the United States, they have a very robust banking, let's say, group which works. What really did not work or they could not work, they were overwhelmed. $40 billion or $42 billion to be very exact today, you know, is not small sum. No matter how much all of us catch our hands, you can't catch hold of somebody falling from the 100th floor of a building. You know, these 40, 45 of us, we are all standing in the ground floor with our hands, you know, linked and intertwined together. Can we hold that sort of momentum? It's almost impossible. I can dare say it is not possible at all. That is the problem. So crisis, when it actually happens, the dimensions are not, you know, something that you can estimate or may not, in fact, will not align with your estimations. And therefore, crisis management is not only about preparedness in a financial crisis, it is also about your nimbleness how to maneuver through the crisis. So this is academically, we can read through this, you know, gain from it. But practically, what is very important? I would like to say, you know, there was a time, I'm going to, this is IPL season. Most of you are cricket, you know, fanatics like me. You know, Sachin Tendulkar, when he went to tour Australia, the Australians found out that this guy was weak in a ball that moved away from the off stump. So what did he do for the next stretch? He decided he will never play any ball outside the off stump. He scored 246 runs in that innings. All the runs scored only on the leg side. Now, two very important issues are here in this analogy. One, he learned a lesson from his previous failure. And second, he learned the lesson and converted it to a practice and put it into practice. And he is on record by saying that every innings you mark your, you know, mark your crease, as they say. You have to know what is happening around you. You have to know, you know, that every single day is a new day. You have to know that all your, you know, predictions are only estimations. What you think will happen tomorrow is an estimation today. What actually happens today, tomorrow, may or may not, more may not, even align with that estimation. If you lose this side, your eye is not on the ball. And look at both the demand and supply. There is a demand factor, there is a supply factor. Each of them are independent, but they are never, you know, working alone. They are almost probably on the same time. So therefore, look for the right indicators that will apply to your organization, your issue. And look at data. Look at trusted sources of data. Don't pick up any data and use it to justify your, you know, prediction. If you do that, you are creating an SVB situation. Okay. Then look at trends. What is happening around you? What is happening to your data earlier? What is the data that you used earlier to extrapolate and what did it actually land upon? You know. Nobody else knows. Only you know. Then what are the experts predicting? Who are the expert? Right now, I am the expert. Right now, for this webinar, I am the expert. So attend more seminars like this, more webinars like this. read through blogs. All these are very important. Now, sir, I'm already overworked. Fine. That is something that you have to answer to yourself. Nobody can give you a solution. And then cherry pick the right indicator. Don't go by the deluge of data. Today, it is not even big data. I would like to say it is bad data. Not all data is good, at least not good for you. So therefore, cherry pick what is good. So if you can beat the curve, your predictive capacity is very, very good. You will stay ahead. At least try to stay on the curve. That means be nimble and make sure your organization is able to trust you to be nimble. So as the chief risk officer or potential chief risk officer, each one of you are responsible for that. And interest rate changes at the policy level, like I told you already, they cannot happen overnight. If it happens, it is political disaster for those guys who drive it, wherever they are, right? We saw some time back a prime minister in an economy as large as the UK losing her position within, 6 weeks or something like that. So we can see it is disastrous to react to something so suddenly. So therefore, it will be a very, let's say, a tested, pushed out process. You need to be aware on top of it, right? So macroeconomic scenarios are very, very important. What are the drivers of your process? I'll give you an example. All of us know fintechs are now, earlier they were seen as a threat to the banking industry for lending. Today, by a single transformation of a policy, fintechs are no longer a threat to the banking industry. What happened? Co-lending happened. So what happened was, instead of looking at that as a threat, bankers started saying is, why can't I use it? So therefore, this nimbleness in an organizational level came at looking, how can I use a situation? So a chief risk officer should be the guy, as I have taken a disclaimer, it is a gender neutral, who is looking at what can happen. If he is looking at what is happening, then he is only doing the routine job of the risk management. Risk management is a process that should got embedded into the process. Risk is owned by the process owners. Risk is owned by the product owners. They should be managing the risk. That risk is what you already identified. That risk is what you identified, assessed, and you plan to mitigate in terms of appropriate risk responses. So you don't have to look at that. You have to look at it time and again to see it is working all right. But you as a chief risk officer should always be working on what is the risk scenario that can, create a situation that can lead to SVB if it is not already an SVB situation. So what can happen is more important to what is happening. If you are still worried about what is happening, then your organization is not even in maturity level 2 in ERM, enterprise risk management. So first bring it to, your maturity stage 4, and then then look at your CRO role. So what are the regulators doing? Regulators world over. Let us focus only on Federal Reserve and Reserve Bank of India now for 2 reasons, SVB being the topic and Reserve Bank of India for our topical references, contextual. So if you look at, this happened on the 8th of March. On 28th of March, Mr. Barr was pulled up in front of, even though I'm using a strong word, was asked to present. Let me reword my saying. Was asked to present before the Senate committee. Senate committee is like our JPC of the parliament. Within 20 days, the system was fluid enough to call him. And what did he say? He said, the framework focuses on size threshold. Systemically important bank, not so systemically important, institution, and so on and so forth. But he was also honest enough to confess size is not a proxy for risk. That means you can be too big, you can fail. You can be too small, you may not survive. So size is no proxy for risk. And particularly when your model, particularly in SVB context, their model was focusing only on the technology industry, both the lending and deposits. So it was a very I have seen a couple of models like that, but they worked very well because most of them were within a particular industries and so on and so forth. Anyway, and a category 4 bank, while they said focuses on size thresholds, less frequent stress testing. This is one very important learning from a regulatory perspective. So because you are a smaller bank, we tend to say low risk, therefore no need to have RBIA. Because the risk is always already low and people are managing it very well. So why should we have a risk-based internal audit? So less frequent stress testing or no bank run capital. What if there is a run on the bank? In 2000, okay, I will obfuscate the year. I was about to cross my own thing. Yeah, there was almost this example that I told you where our regulators immediately woke up and set up enough mechanism to ensure such a mechanism doesn't happen, and therefore later day, after almost 18 years, when a similar situation happened, not for same reasons, but still that organization was saved because of the regulator's intervention. So no bank run capital stress, less rigorous capital planning, and liquidity risk management. LCR, the LCR is seen once in a year requirement. In many organizations, LCR is done on a regular basis. Regular basis, you will be surprised. Some of the very large organizations where data capture, data management is done in a very highly efficient manner. It is done almost on a weekly basis. And some of them where we were discussing post SVB, they were saying, sir, we are, some of the functionaries today who are my ex-colleagues, junior colleagues and all that, they were telling me, sir, we are trying to make it on a daily basis. I was very surprised. So to that extent, mature organizations try to do. This is from the Michael Barr's statement. So a very interesting thing happened very recently, just about a week back. RBI, which sells the bonds, rejected all the bids. Okay. Now, this is not the first time that has happened, but what is very interesting is this particular, highlight. The reason that they, rejected the bids was people wanted a higher return in their bids, and that would have upset the yield curve. So RBI rejected the bids for those bonds. Now, what does this tell you? It tells you what followed in the announcements that came after the MPC, recent MPC that happened on the 6th of April. MPC, as most of you know, is the Monetary Policy Committee of the Reserve Bank, which is the, highest body for any decisions on interest rates and other things. What did they do? They went on a pause mode. It's very important to look at the repo rate pause that is highlighted there. And if you look at it, it was a decision taken with one member on the MPC saying, no, we should not pause it. We should hike the interest rate to meet the inflation or inflationary conditions. However, they looked at both the macroeconomic and the financial conditions. This is very important to note the last of the highlighted points. Now, they have also gone ahead and told various other things. Very important, the reason I am putting it up here is for all of you who are aspiring to be better chief risk officers, future chief risk officers, very good, risk management professionals. Please look at all these statements. They tell a lot more than what they say in the grammar, the English. These are indicators for us to take back to our, drawing board to see how to adjust our own policies to react. And this is a continuous process. As they say, we are now waiting for the 8th of June, where the next MPC. So between now and the next MPC, the various events that will lead to see whether this pass is working, whether this pass is now bringing better, results in the market, whether it has helped the banks to hold their, let's say yield curve better, so on and so forth, will all come out. So we have to keep our eyes on the ball. So if you want to summarize very quickly to bring this webinar to a conclusion, when your investments are solid, keep your eye on the interest rate changes. When you are holding them more for trading, that means it doesn't matter whether it's solid or not, then you look at price changes. Then when you're gung-ho, this is the reason I told you. When your organization is gung-ho on one side of the balance sheet, put your back up. If it is gung-ho on both sides of the balance sheet, don't even sit down, get up. And make sure that your liquidity is there. So if you're not keeping your eye on the LCR, right, I would say on a weekly basis, whether you're required to monitor and report it to your reporting, cycle or not, that should not drive you. See, I always tell people, don't do the regulatory requirement. They are the minimum required of you, right? You can't go below that. You can't say, no, I cannot meet this frequency, but you can do better than that. Regulatory requirements, people tend to respond because RBI wants me to report. RBI wants you to report, but what is your thinking on it? Can you make it more frequent? RBI doesn't say, you cannot make these calculations every week. So they say you have to report it in this frequency, but you can do these. Always work on what if. What if whatever Sridhar said is wrong? What if whatever Sridhar said is correct? That is the question that you need to constantly ask. I hope some of this would have been useful. I'm hoping all of this would be useful. Thank you for all the time patiently listening to you, to me, and to see whether India can have a SVB situation. Please go to this link. There's a beautiful article that came out in the RBI Risk Management Association website. Beautiful article, whether SVB situation can arise in India. Please read this article. I'm not going to summarize it. At least some of you will go read that article. Please do. Thank you for taking time. Thank you for being here on a second Saturday. I hope some of it was useful. Questions and answers, whatever I can handle, I will try to be of best help.
Thank you, Mr. Sridhar, for the excellent inputs. If anybody has any question, you can just raise your hand. So, meanwhile, there is question from any participant. I would like to know what should be the next step, role of risk managers in the board, because we have seen that risk management department is there, but their presence or their voice is not heard that much in board. So I think time has come when the board should recognize the importance of this department and give them due weightage to hear them and to give them enough liberty to save that particular company, bank, or whatever it may be.
Sir, wonderful question, Dr. Rakesh. I would like to start by saying we need to go back right to the Companies Act. Today, Companies Act mandates 3 committees: Audit Committee, the NRC, the Nomination and Remuneration Committee, and Stakeholder Complaints Committee. Nowhere we are talking about risk management. Even though Dr. Shaktikanta Das, the governor, very, graciously in his December MPC meeting, he said, our focus is going to be on the SAB and RMCB functioning of our governance levels at the financial institutions, which covers all the banks and the systemically important NBFCs. But that is fine. That is what the governor has opined, which is very, very important. It's a very leading light and leader for what the board level governance should be. But we need to bring it into the into the Companies Act to make it a mandatory committee. We need to have every organization, have a risk management committee, not because we are Risk Management Association of India, because we want to manage the stable and not just shut the door after the horses have fled. So if you want to be proactive, we need to bring in a legislative. Unfortunately, in our political or socio-economic situation, only mandated things are seen as, above the, recommended, requirements. So that is the first step we need to do. Second step is to make sure that the risk management, let's say professionals on the boards of companies, particularly banks, but more importantly, because banks' clients are the risks for the banks. So it is also important for the clients of the banks, the corporates, at least the leading corporates, to have similar risk management professionals and identify the risks, or support the risk management function in a manner of not only academic inputs, in terms of quality of people, in terms of course corrections, and so on and so forth. So therefore, I would think it is a, one from a regulatory legislative platform, what I said as point one, and two, from the participative organizations, understanding what the particular role of risk is, so that we can prevent even a large, organization. And if you recall, when 2008 and subsequent quantitative easing came, it was predicated on too big to fail. Today, too big to fail is absolutely meaningless, because SVB was not a small fly by any description. So therefore, at the board level, I would like to say that I try to make it as much as possible my own contribution where I sit today, but to bring in this knowledge to bear so that the actual practitioners on the ground can benefit out of it. They have a leaning post where they require this and a sounding post where they need to sound it out.
Thank you. Thanks a lot.
Thank you, sir. Anybody wants to ask any question, they can unmute themselves also. The right has been given.
Yeah, Mr. Prasad, I think, has a question.
Yeah, Mr. Prasad, I see your question.
Yeah,
Indian companies' exposure in SVB. Oh, yes, there are a lot of Indian companies which have a lot of US clients. So many, your own town, Bangalore, from where you come.
Yeah, I heard many names. Is it quite serious to affect the sector, or what's your opinion?
Again, answer is yes and no. Yes, it is serious, because what will happen is once bitten, twice shy. So they will be now very, very careful about where they park their funds. Now, this is looking like very good, but it is not. Whether they have lost money, the answer is no. Whether they have lost money, the answer is no, because what has happened is at both the US and the UK end, the investor, the depositor protection is kicked in, and most of the Indian companies, at least I can tell you, in fact, most of the non-US depositors have got protected. Some of the major losers, if we were going into granular detail, which is not required actually, but some of the major losers are within the US, let's say, fraternity. Some of those companies, US-based companies, are owned or at least co-owned by some Indian investors, but they are of Indian origin more than Indian passport.
Yeah, because I got a leading question on this. Can I?
Yeah, please.
Yeah,
Yeah, please go ahead.
because one or two companies whom I know, the software companies, they got huge exposures. They want to explore the possibility of claiming under the direct set office's liability insurance, this amount. Of course, I'm coming from the insurance perspective, but is there a real exposure for the CFO, CEO, or whoever has taken the decision to park in these type of banks without disclosing or whatever it is like that? When it gets nasty, everybody will be hauled up.
Absolutely.
So is that an exposure for the companies?
Yeah, but it doesn't come to even a claim, Prasad, because it is not even an insurance company backup. The banking sector, even in India, we have, deposit insurance guarantee. Now, deposit insurance guarantee, though it does the role of insurance, there are thresholds. And if you're on that particular given date, if your name appears in the books of the bank that is affected, the claim is automatic. So there is no need to, let's say, establishing the claim or anything like that. What has happened here is, it is a mixture of both, DICGC sort of a cover through the Federal Deposit Insurance. And in the UK, it has simply got transferred to another bank. So that bank has taken over the liability. So it became a very seamless transfer of the dues to the bank. Now there will be some procedural delays. Even in the Kuwait war, I still remember in the 90s, early 90s, the reparation claim was predicated only at that material time, whether you are in Kuwait or not. That's all. Very simple milestone to prove or disprove. But what happened was the procedural time took, the process took some time. So in fact, some of the bankers stepped in. I'm not suggesting that you create a product for this, but some of the bankers stepped in as some bridge saying, okay, anyway, the claim will come from FDIC or something like that. So we will step in. So here, I don't see an insurance sort of a hit. Ultimately, reinsurances and other things might come because SVB might have taken policies against its collapse. I don't know details, at least they are not surfacing. We are not getting details about all that. Yes, there will be overall risk ultimately. But since the apparatus, the government or the, let's say, regulatory apparatus have kicked in, it has been fairly, let's say, the granular level at the individual level loss have been quite well managed. But then ultimately, who is going to pick the tab will be a different question.
Would like to just have a look at the first question that I raised because it's a bit sensitive. I don't want to publicize that.
I know a couple of names. You also know.
Have they given money? What I heard, read was that they lent money to some
a couple
political
of companies
movements.
that I know, which consulted me immediately, have already got their money.
Okay.
There are some of them who are still having, because their monies were large. Monies were large.
Okay.
$100,000 and below, everybody got their money immediately, next day morning. Which in the United States is not a big amount. For us, it was about 92 lakhs. Some of the, one particular company, they got it the next day morning. Actually, on the 11th of March, they got the money.
So, anybody else has any question?
But sir, it's point to both of Dr. Agarwal and Sridhar sir. What had happened to Deposit Guarantee Corporation increased the limit since last year.
Yeah.
Rajasthan State Cooperative Department people and Karnataka also, they expressed interest to suggest to the banks to top up this amount. Okay, when I contacted one reinsurance company from Lloyd's, they were ready to offer the cover. Excess of 3 lakhs to 10 lakhs, they want to offer cover, but entire cooperative bank had to be covered. But it just fizzled out. But people know that capacity is available, insurance is available for deposit holders in excess of 3 lakhs offered by Deposit Guarantee Corporation. So is it possible for Risk Management Association, or I don't know how to move it at the state level, this one, to force every cooperative bank to at least arrange for additional cover so that ordinary deposit holders, say up to 10 lakhs or 15
now it is
lakhs,
mandatory, Prasad. Now it is mandatory. Cooperative banks
only
also come
DGCA
under
is 3
RBI.
lakhs.
Yeah, but they come under RBI. Now
Yeah,
it is
excess of that
mandatory. I
can
think
be
there has been
interest
given
funds
a
available.
staggered approach, because of the cost involved, and their, by definition, their revenue streams are different. So they have been given a staggered approach. I don't know details, but they are no longer protected under the Cooperative Act. They are now under, as a financial institution, they come under the RBI regime.
Yes. So
And
that the protection is gone for that, for the deposit holders rather. Yeah.
No, protection, their step, see, again, cooperative by definition is for its members. So therefore, some of the, let's say, issues will be carried, the risks will be carried with other members for their members. That is the basic idea of a cooperative, isn't it? You win together, you lose together.
And maybe in due course, this limit of deposit insurance corporation will also increase because
no, it will come, sir. Staggered. It's staggered. I think once the
Hmm.
cooperative sector comes fully under the banking sector comes under RBI, then the other capital adequacies and other things will come in gradually, like UCB. Urban cooperative banks are already there, so it will come in. It's only a matter of, let's say, it is on the waiting on the curve for its maturities.
Any other questions?
Dr. Agarwal, can I request that people can send in, if you can share the email and all that?
Sure,
they can send in the email also. I would be very glad to, answer questions with whatever little knowledge I have.
In all this situation, I think the time for risk managers and risk people wanting to come in the industry is very bright, because the situation which started from COVID and which is after Ukraine war and all, I think risk management professions, maybe job or advisory or similar services, this would have a very good demand in coming days and years.
So if there are no more questions, I thank you for this opportunity. Thank all participants for their patiently listening to what I said. Thank you so much, sir. Jai Hind.
Thank you, sir. Thank you so much.
Thank you all participants for attending the session. We shall be coming with a next session maybe after next Saturday. So we will keep you updated. You can just visit our group also, so to get the details of our next session. So thank you again, everyone. Thank you, Mr. Sridhar, for an excellent session. So look forward to next session again.
Thank you, sir.
Thank you.